Welcome to the first video of the course module in which we will be dealing with the international aspects of business activity and in particular the international economic environment in which multinational companies operate. In this video we will discuss the theory of international trade as well as the most commonly found barriers to free trade. In further videos of the module, we will explain the role that the world's major international trade agreements, international economic organizations and banks play in global trade. We will also talk about international financial markets and analyze the negative aspects associated with the free flow of capital, such as the recent global financial crisis. According to a commonly used definition, a multinational company is any business whose revenues generated from sales to countries other than its home country exceed 25%. As you can see, many entities may in fact be considered multinational in light of this definition. In the case of all such companies, it is therefore essential to understand the global economic environment in which their international activities are pursued. Let us consider why companies decide to do business internationally, or to put it in other words, what are the reasons for the existence of international trade? The phenomenon of international markets may be explained using several concepts. The first is diversity. Not all goods may be produced in the domestic market of a country, and without the ability to buy imported goods, consumers would not have access to certain products. Another reason is competition. The fact that foreign companies can access local markets increases the level of competition in those markets, resulting in lower prices as well as boosting the innovativeness of local companies. Finally, economies of scale and specialization are further justifications for the emergence of international trade. As a result of manufacturing goods for both the domestic and foreign markets, companies can achieve economies of scale and, as a result, maximize their efficiency as well as offer more attractive prices than their smaller competitors. Specialization has a similar effect on efficiency and prices. Economic theory goes deeper, providing an explanation for why entities should specialize in the production of a given product and subsequently export it to other markets. The explanation comes from the comparative advantage theory as developed by English economist David Ricardo. According to his findings, individuals, companies and countries specialize in the activity in which they have a comparative advantage, as measured in terms of endowments or technological progress. Let us explain the law of comparative advantage using a simple example. Imagine an individual who has skills in producing shoes and making wooden chairs. During one working day, he can either make a pair of shoes or one chair. His neighbor has similar skills, however is less endowed, and it takes him 3 days to produce a pair of shoes, and 1.5 days to make a chair. Is there any reason for which any of the two producers should give up production of one of the goods and specialize in producing the other? Well, as you probably have noticed, the first individual has an absolute advantage in the manufacturing of both shoes and chairs, and the first impression may be that he cannot gain from specialization and trading with the second, less efficient individual. However, the answer changes when we consider the opportunity cost associated with production of the two goods by each of the individuals. Assume that a pair of shoes costs $250 and a chair costs $200. If both individuals stick to producing both goods, they will have to split their time between them. For example, during a working week of 6 days, individual 1 will spend 3 days making shoes, thus earning $750, and 3 days making chairs for a further $600. As a result, his weekly revenue will amount to $1,350, and the production output will be 3 pairs of shoes and 3 chairs. At the same time, his neighbor will devote 3 working days to make 1 pair of shoes, for which he will receive $250, and 3 days to make 2 chairs for $400. So his weekly revenue will come in at $650. The total production output of both manufacturers will therefore comprise 4 pairs of shoes and 5 chairs, and the total revenue of the 2 entrepreneurs will amount to $2,000. You should appreciate that by choosing to produce a mix of goods, neither of the manufacturers are maximizing their revenue. If individual 1 gave up making chairs and concentrated only on shoes, he could produce 6 pairs of shoes in a week, earning $1,500 instead of the current $1,350. Similarly, individual 2 could earn more money if he only produced chairs. In such a case, he would spend 6 working days making 4 chairs and earning $800 instead of $650. The reason behind the economies from specialization stem from differences in the opportunity costs faced by each of the manufacturers. For the first individual, the opportunity cost of earning $200 for 1 chair is losing revenue of $250 on a pair of shoes, which could also be produced in 1 day. So, for individual 1, the opportunity cost of making shoes amounts to 0.8 of a chair, or 200 divided by 250. By analogy, the opportunity cost of making a chair amounts to 1.25 of a pair of shoes, which can be calculated as $250 divided by $200. In order to calculate the opportunity costs for individual 2, we need to calculate his daily productivity for both goods. Knowing that he can make 1 chair in 1.5 days, his daily revenue from producing chairs amounts to $133.33, and knowing that he needs 3 days to make a pair of shoes, his daily revenue from shoemaking amounts to $83.33. So, the opportunity cost of making a chair amounts to $83.33 divided by $133.33, that is 0.63 of a pair of shoes, and the opportunity cost of making a pair of shoes amounts to $133.33 divided by $83.33, that is 1.6 of a chair. As you can see, despite individual 1's absolute advantage in the production of both goods, the opportunity costs of making the goods are different for the 2 producers. In particular, individual 2 faces a lower opportunity cost of producing chairs than individual 1, which means that he has a comparative advantage in making chairs over individual 1. Simultaneously, individual 1 faces a lower opportunity cost of making shoes than individual 2, which gives him a comparative advantage in shoemaking over individual 2. The theory of international trade assumes that the flow of goods and services among countries is in fact 3. Reality in this respect is, however, far different. In fact, for many countries, the import of goods from other, more efficient states is a threat to their local industries. Consequently, in order to protect their domestic markets, countries often impose restrictions on imports which form barriers to the development of international trade. Let's take a look at a couple of the most commonly used types of restrictions. The first type of trade barriers are tariffs and quotas. A tariff is a tax levied on imported goods, with the aim of making imported goods less attractive to domestic customers in terms of price. A quota, on the other hand, is a limit on the quantity of goods that can be imported to a country over a period of time, and the goal of its implementation is similar to that of a tariff, in other words, limiting the impact of competitive foreign products on local business. Probably the most severe barrier to trade is an embargo, which is a complete ban imposed on goods imported from a certain country. Please note that an embargo is typically used as a tool to exert pressure on the political leadership of a country, rather than as a means of defending local markets. Nonetheless, from the perspective of a multinational company, an embargo is a barrier to trade, which is difficult to circumvent. Other types of trade barriers include exchange controls and administrative controls. Exchange controls are restrictions imposed on transactions in foreign currencies, aimed at limiting the volume of imports. An example may be a ban on using a foreign currency within a country, or limiting the amount of currency that can be imported to or exported out of the country. Typically, exchange controls are used by underdeveloped countries, as well as those countries whose economies are undergoing transition. Administrative controls are aimed at deterring potential importers by implementing extensive administrative requirements and bureaucratic paperwork in relation to such transactions. Multinational companies who wish to expand to countries in which significant trade barriers exist are forced to find ways to bypass them. A potential way of avoiding trade barriers, which is often welcomed by the government of the target country, is locating production facilities directly in that country. While some countries apply trade barriers, in many areas of the world, free international trade is promoted and encouraged. This is done primarily within free trade zones, usually set up by groups of countries located in the same part of the world. It is interesting to note, however, that free trade zones, whose members may do business and transact without barriers among each other, often impose high barriers to trade with non-member countries. In the next video, we will be talking about the world's most important trade agreements and organizations which promote international trade.